Welcome to the Smart Society Show. I'm Bryn Kennedy.
I'm Chris Skidmore.
Each week, the Smart Society Show brings you the latest in climate and technology markets. And we bring two guests to the show, one climate leader from the public or the private sector, and one climate technology founder or CEO who is driving innovations to help us achieve net zero in our Chasing Unicorns segment. Today, we're very pleased to have Rachel Kyte joining us for our Climate Leaders section. She's a real leader in climate markets, carbon markets, and I think you'll really enjoy the discussion with her. She'll be followed by Allister Furey, the founder and CEO of Sylvera, which is one of the leading climate data and carbon rating companies here in the UK. But before we get to our guests, it's time for the news. Chris, over to you.
Thanks, Bryn. So in this section of the podcast, we're going to cover what's news in climate and tech markets. So both myself and Bryn are going to pick up a couple of stories that we think are key interests that have been breaking over the past week. I'm currently in New York, where we're going to spend the next podcast focusing on some of the updates that come out of New York Climate Week. But for this first episode, we wanted to pick out a couple of news agenda items to kick off the show. One of them in particular is the news that the US government has finalized the voluntary standards around the voluntary carbon market. Guidance that was initially published in December has now been agreed. This effectively sort of sets out a framework by which companies should adhere to around some of those carbon standards. And for me, it's a really welcome addition to some of the work that's been taken forward by people like Rachel Kyte at the Voluntary Carbon Markets Initiative, and begins to show, I think, a direction of travel towards, moving potentially from the voluntary carbon market, maybe towards a more regulated market. And I think all of this points towards COP29, and also when we're going to see potentially Article 6 of the Paris Agreement get sort of final agreement. It was also in a letter that the COP president, Mukhtar published, stating that this was going to be one of his priorities. So I see the announcement by the US government as being really welcome in providing additional certainty that the government, does back the voluntary carbon market. It wants it to succeed. And hopefully this could be really good news in the long run for those tech companies that are seeking potentially to use offsetting or carbon streaming as a means by which to finance their projects.
For sure. And it's very topical with our two guests today. As you mentioned, Rachel Kyte's been one of the leaders in driving the world forward toward more comprehensive carbon market legislation. And Allister Furey at Sylvera are playing right in the middle of that space. So good timing. Well, the US government's also been busy this week or the last couple of weeks. Obviously, one of the other big pieces of news in financial markets is that the Fed decided to reduce rates by a full 0.5 percentage point, which is a very large reduction. And typically they reduce rates by about 0.25 point if you look at the historical context. What we wanted to talk about today was the impact of that rate cut potentially on climate technology funding and climate markets. Certain climate businesses require large amounts of capital to scale. Some of them have large hardware components. Some of them have large energy generation components. Some of them have large infrastructure components. And very often these businesses are raising not just venture capital or equity funding, but they're also relying on debt funding and also relying on off-balance sheet project financing. We often like to say as investors in the climate space that figuring out the project financing puzzle to scale a climate technology company with non-dilutive funding is somewhat of the holy grail of climate finance. This rate cut should make it a bit easier for climate tech companies to access different debt structures, both on and off balance sheet, and to raise that critical project financing for scale. So we look forward to seeing that rate cut reverberate through the funding markets. We look forward to seeing it reverberate through decisions across the rest of the world. And overall, we just think it's very, very positive for equity markets and climate markets.
Yeah, I think it's going to be really important to see now how the UK, the Bank of England responds, how other European banks respond to this US rate cut. So we had a quarter base point cut in the UK. But for myself, going around meeting with either climate tech companies or renewable energy providers, they've been constrained due to the rising interest rates over the past couple of years, has prevented the build out of capital projects. And to paraphrase Bill Clinton, it is the interest rate stupid. We're not going to be able to deliver the extent of the transition without having effective access to capital. And obviously that both means debt markets, equity markets, and interest rates obviously play such a critical role in that. So fingers crossed, globally, we might be in a situation where we see some green shoots, as it were, when it comes to understanding. Now we can sort of maybe power on, companies may be a bit less constrained if access to finance is more readily available as a result of this cut. We've reached a point in the UK now where it seems inflation is obviously peaked, it's going down. The response now is to make sure that the banks need to make sure they don't leave it too long, by which businesses would suffer. We've got the budget in the UK on the 30th of October, so I'm looking to Rachel Reeves to hopefully make an announcement around wider package of fiscal support might look like.
Mm-hmm, for sure. I think my prognostication is that I think we'll be on a downward rate curve across Europe, the UK, and the US for coming years, which I think should all be positive for climate markets. The other thing that lower rates does is it generally helps public equity markets. Obviously, after the US rate cut was announced, the public markets did very, very well. And we need vibrant public markets so that companies can go public and so that investors can get liquidity and then recycle their funds back into new innovations and new companies. It's been very challenging in recent years with fewer IPOs, fewer exits, less liquidity for investors in terms of reinvesting then back in early stage companies and new funds that are driving those early stage companies and their innovations. So all good news. We'll all stay tuned to see what happens. But as you said very eloquently, Chris, definitely green shoots.
So, Bryn, the third piece of news that I wanted to raise in the podcast is an area of focus that we're going to probably look at in subsequent episodes, and that's around new nuclear. Obviously, decarbonisation, people think about sort of low carbon technologies, potential opportunities for reduction or removal of carbon. But we do need to be focusing also on alternative technologies, opportunities to decarbonise by moving to other forms of clean power, of which nuclear is one of them. And there are great opportunities both in the UK, in Europe, and the United States to focus on what new nuclear might look like as part of the energy transition. So the announcement that Microsoft is going to partner up with Constellation Energy in order to restart Unit 1 of the 3 Mile Island nuclear plant in order to help reduce the carbon intensity of some of its data centers, I thought was really interesting. It's a bit back to the future. Repurposing and reopening plants that have already been mothballed is welcome if they obviously can continue for a certain amount of time. In the UK, we've reopened plants or extended the life of plants. I do want to see investment in new nuclear. There's some great projects, whether that's small modular nuclear reactors or advanced modular nuclear reactors. We're hoping to have a number of those companies come and speak to us about what they're doing. So I hope that this doesn't sort of hold back innovation, but it's a really welcome, I think, to see the sort of turning of the tides, recognizing that nuclear is potentially a safe alternative. And obviously the States is the largest supplier of nuclear energy, 94 reactors. So hopefully this can also be part of the transition. It's just obviously waiting to see what will happen. I hope that more additional financing will come forward for new nuclear as well as for repurposing old nuclear.
Yeah, and it brings up a really, really interesting topic, which is the tension between the growth of the AI economy and climate tech or decarbonization. We have massive, massive increases in the demand for energy driven by the energy requirements of large language models and all of the energy consumption of AI overall. And that will continue, which is invariably why companies like Microsoft need to set up their own power deals. I think this is sort of the first time in history that we're seeing something like that. And at the same time, we have to serve that increasing energy demand with more green and more renewable energy so that we can facilitate an energy transition. It's a real tension. And I think a point that's not talked about enough in climate markets is that growth of demand. And, it's not just AI growth, Chris. It's also growing energy consumption from the global south as many countries industrialize. It's growing energy consumption from 5G and various other technologies beyond AI. So presents a really, really difficult puzzle for the world to solve.
Yeah, I think a really interesting tension amongst sort of, emerging economies, obviously not just developing economies, but also those new technological economies that do, need the extra energy, such as data centers. And also what demand it's going to place on grids that need to emerge as a result of the energy transition. So definitely one to watch this space. And I know that other companies like Meta are potentially interested in using geothermal energy to power data centers. I think there's going to be a whole new industry that comes out, in order to look at how we can finance potential renewable and clean energy projects to provide the energy for data centers. Well, I think that covers some of the news that we wanted to pick out. Next episode, we're going to focus on some of the things that have been going on at New York Climate Week and some of the updates from UNGA as part of our second episode on the podcast. But I think now is probably time to move on to our next section in a moment, which is our climate leaders interview with Rachel Kyte.
Well, welcome back to the Smart Society Show, where we're going to now kick off with our first Chasing Net Zero interview. Each episode, we'll be speaking with a climate leader from either the public or the private sector, someone who's already made a key contribution to delivering on the path to net zero, whether internationally or in their own country. And we're hoping to provide greater insight and understanding into that individual's own journey, their own plans for the future, and how they see the future challenges and opportunities to decarbonise taking shape. And I'm delighted to introduce as our first guest, Rachel Kyte, one of the leading international voices in climate policy. Rachel, thank you so much for joining us on the show today.
Well, thanks, Chris. It's lovely to be here.
Now, Rachel needs no introduction. She's probably fed up of people even saying that. But for our listeners, I wanted to give a sense of Rachel's impressive background in working in climate policy over the past several decades. She served as Special Representative of the UN Secretary General and Chief Executive Officer of Sustainable Development for All. She was previously also the World Bank Group Vice President and Special Envoy for Climate Change, leading action on climate finance, in particular in the run-up to the Paris Agreement in 2015. Rachel is currently co-chair of the Voluntary Carbon Markets Integrity Initiative, VCMI, which is working to build high-integrity voluntary carbon markets. And she's also a member of the board of Private Infrastructure Development Group with responsibility for ESG, a member of the G20 Expert Working Group on MDB reform, appointed by the Government of India, and she's an advisor to General Atlantic's Beyond Net Zero Fund, and a member of the board of the Carbon Policy Initiative. So, Rachel, what are your proud achievements to date, if you don't mind, and where do you see your own work taking you over the next few years?
Oh, great questions. I think if I look back, the things that I'm the proudest of are where we've been able to bring a sector or an unlikely working coalition together, and it's lasted, right? So back in the early 2000s, the idea that banks could set their own standards for the way in which they behaved, right? And that morphed into the Equator Principle. So this is work that I did at the International Finance Corporation. The very early discussions with central banks and banking regulators about the risks that they ran if their financial sector didn't understand sustainability properly, which has led to coalitions, and then the extraordinary work by NGFS, which is a coalition of central bank governors that work on climate as central risk to financial systems, bringing all the multilateral development banks together to talk about climate, first of all, which they didn't used to do because climate wasn't considered a development issue. This as recently as sort of 2012, 2013. Getting all of the multilateral development banks to start to think about climate as actually central to their ability to deliver their mission. So I think, and I could go on, but I think that these are the lasting testaments to the way that we have to work differently together, and the way in which we have to rethink rethink what development means, right? Today, you hear this very strong voice from emerging markets and developing economies, which is that they don't really want to have any more development or aid conversations. I mean, what they want is a conversation about global trade and global investment that recognizes that they are hyperpowers in terms of their access to renewable energy, to critical minerals, to youth population, which is going to be the source of innovation for the future, and that they need to be at the table globally to talk about these issues such as climate change in a way which is respectful and in a way which reflects this modern world rather than the institutions that we have today, which reflect how the world looked in the middle of the 20th century. So what do I do going forward? Well, I've been trying to work with private capital, public capital, and philanthropic capital so that they can work better together to take greater risk earlier in order to be able to sort of finance the transitions that are necessary for climate action. And then I think the other thing is that I teach. I'm currently at the Blavatnik School at Oxford. And let me tell you, every single time that a student gets the job that they want, committing themselves to public service or to the third sector or the private sector, and they will have careers that weave in and out, and that they can bring their intellect, their optimism, their hope, and their energy to this issue. That's probably when I feel the best.
Mm-hmm. That's great, Rachel. Thank you so much. Well, the early stage capital gap is near and dear to my heart as a climate tech venture capital investor. So very happy to hear you hit on that one. Switching gears a little bit for the next question. You're the founding co-chair of the Voluntary Carbon Markets Integrity Initiative, a multi-stakeholder international organization enabling a high integrity voluntary carbon market. And last year, the VCMI launched its Claims Code of Practice, followed by the launch of carbon integrity claims. I'm curious what has been the response from companies to this new framework. Are you seeing a positive impact from this launch?
So if we just it's a great question. We step back a little bit. We're in this very sort of strange moment in the terms of the growth of carbon markets overall, right? So countries, most emerging market developing economies are looking at carbon markets in an integrated way and thinking about, well, how do I exploit the potential of carbon markets for my own transition to net zero, but my own resilience and development. And so that means that for a country, they want to understand what is going on in the negotiations around Article 6, which is the sort of market mechanisms piece of the Paris Agreement. They want to understand how the voluntary carbon markets might grow. They want to understand what some of the drama in the newspapers is about bad things that have happened and about whether or not the voluntary carbon markets can actually grow. And they want to understand what's happening as developed countries put carbon border adjustments in place, CBAM in the EU, the UK, potentially the US maybe. So they're looking at a world where only about a quarter of emissions come under some kind of effective carbon pricing at the moment. And really, one would think logically that all emissions should come under some effective pricing, and they're thinking, okay, well, what do I do? So, since the Glasgow COP, there have been an intensified work both by VCMI but also by our sister organisation, ICVCM, the Integrity Council for Voluntary Carbon Markets, to put guardrails in place. So if you buy a carbon credit, you know that it's a high quality, high integrity carbon credit. That's the work done by ICVCM. And we've put in place a code of conduct for companies. But while all of that's been going on, there have been sort of attacks from both the right and the left, from some parts of the environment movement that have looked at the sins of the past. They've looked at mistakes that have been made in previous versions of the carbon market and said, look, markets can't actually solve the problems that we have. They won't lead to reductions of emissions, etc. And we see attacks from the right, from in particular sort of originating in the United States, this attack on woke capitalism. And so companies feel a little bit trapped. They want to move through their transitions more quickly. They want to understand what the rules of the road are for your transition. They want to know when they can use the carbon markets and not be attacked as greenwashing, or use the carbon markets and not be attacked and fear a lawsuit from an attorney general in a state of the United States. And so what lots of companies are doing is saying, okay, I need to use the carbon markets, but I'm actually going to sit on my hands for a little bit until it becomes all clearer. Brave companies are starting to use the code of conduct. And I think that there is a lot that needs to be clarified. But at the same time, I think in further east you go, you look at Asia, look at Singapore, you've got a number of places that are becoming hubs for carbon market activity. And, I think that while this sort of argument is going on in the liberal West about the perfect driving out the good and whether, ESG is evil, the rest of the world is just going to move on because countries desperately need the revenue stream from integrity in carbon markets, and companies need to find ways to be able to meet their net zero interim targets, especially when the technology just doesn't exist for them to be able to do that for their own account. They need the markets. So I think we're in the middle of a quite interesting position where politically we're a little becalmed, but the pressure from both the demand and the supply side is just growing.
Rachel, really interesting what you're saying about companies and their willingness to move faster. When I did the UK's net zero review, I did countless number of businesses and organisations saying that they were confident they could manage their scope 1 and 2 emissions, but for them the overwhelming challenge was scope 3. And I know this is now something that VCMI is focused on, and I understand this month that you actually launched a public consultation on a beta scope 3 claim. I just wondered, what do you think of the opportunities that high integrity carbon credits for its scope 3 emissions in particular can bring for those companies, and how can they be best delivered? Obviously, the work you've taken forwards is on scopes 1 and 2. Do we see ourselves moving into a space where companies can confidently potentially mitigate their scope 3 emissions in the future?
Yeah, so I think so. I mean, I think that from a transition perspective, first of all, companies need to have a sense of how they are going to transition. Obviously, there's a huge role for government and the public sector in terms of making clear what it expects from companies. I think there's important work over the next couple of years to agree what effective transition pathways look like by sector, with some geographic flexibility as well. So we should be comparing, chemical companies to chemical companies. The transition pathway for a food and beverage company will be a little bit different. The transition pathway for a commercial bank will be different again, right? So are we confident enough that we can sort of plot out transition pathways, hold companies to account for that transition, and then every individual company will be able to meet its scope 1. Depending on where they are in the world, we'll be able to meet scope 2-ish. I don't know. We get lots of pushback, I think, from companies about how easy scope 2 is. And then scope 3, yes, there's going to, for the vast majority of companies today, in today's regulated world, jurisdiction by jurisdiction, they're going to need help. But the point is that, or flexibility, but the point is that it's got to be a part of a pathway where, the flexibility is not for you to get out of your commitments to net zero. The flexibility is to allow you to invest more earlier in order to keep moving through your transition pathway. I mean, the bottom line here is that we need more companies to be doing more. And at the moment, there's sort of, if we think about the companies that have got science-based targets under SBTi, those are leading companies. Those are companies that are voluntarily investing in their value chain and in their business where nobody's really requiring that of them. We need more companies to be doing that. But that means that they're in transition. Setting the target is one thing, but then setting out your interim targets on how you're going to get there, and then finding a way to be able to meet that target in a world where you might not be helped by the regulatory framework. You're not helped by the the yelling and shouting that's going on the margins. So our approach to this is hold companies to account for the right thing, and then give them the flexibility to try to get there, if that means that we can get more investment into more decarbonisation earlier, because that's what we need. The transitions are underway, but they're not on pace.
Yeah, and I might be a little bit biased here as the venture capital investor in the room, but I think there's a big role to play here for early stage companies and startups that are launching new solutions for carbon markets and carbon credits. And, many of them we're looking at. In fact, today I'm doing this first podcast from Switzerland's top 100 investor event, where we have all kinds of climate tech companies pitching to investors. So my question to you, Rachel, is many early stage companies and startups are seeking to deliver high integrity carbon credits, or at least claiming to do so and building toward that. Are you beginning to get a better sense of what are the most reliable and secure technological approaches and, those that can deliver real change rather than be caught in that greenwashing scandal that you mentioned again?
Well, I think that there's significant interest. And if we look at the market in 2024, 2023, the sort of hottest part of the market has been big tech firms buying up carbon removal startups and technologies. And so obviously that's, I think that's, and if we look at where we are in our journey towards net zero and 1.5 and the possibilities of overshoot, then there's enormous interest in anything that is in the technological removal business, because it's verifiable, it's easier to measure, etc. I think where we need a lot more work, and obviously there's been some innovation here as well, and some of the big tech firms have come together to try to find ways to more easily invest in nature, is the nature piece of the voluntary carbon markets, because that's where a large part of the sort of emerging market development economies, first of all, they have nature resources that they need to protect for their own resilience and for our own global emissions trajectory, and it's very hard to invest in those if you don't use carbon markets. And so I think that one of the things to look for is any of the companies that are looking at ways in which to protect nature. And whether or not whether the market starts to grow in confidence with the work of ICVCM and VCMI, and whether we can start to see that happening. Next year, of course, the climate talks move to Brazil, and there's perhaps unrealistic or certainly super high expectations of what Brazil will be able to engineer in terms of a global conversation around the value of nature in the climate debate. But there's lots of room for the Brazilians to actually underpin and build more confidence into carbon markets in general. So I think that's one thing to look for as well.
Rachel, you just mentioned Brazil, and obviously COP30 being another ambition COP. From next February, I believe, into COP30, countries are going to begin to publish their revised national determined contributions 3.0, I think they're now called, with revised and heightened levels of ambition. I was wondering, what role do you think the voluntary carbon market can play in working towards delivering these new targets and raised level of ambition in the NDCs?
So I think that there are a number of different entities that are working with countries to help them think through how do they build an effective carbon market domestically, and how do they tap into carbon market activity, whether it's the voluntary carbon market, whether it's activities under Article 6.2 or 6.4, that's bilateral agreements, or a new UN carbon trading system. And so each of those countries actually should be able to explain in its NDC how the building out of its carbon markets would help it achieve its ambition. And I think, the World Bank has an important role to play. The multilateral development banks, where they've got the capacity, have a role to play. VCMI, where we regularly convene well over 50 countries that are working on these issues in detail. The UNDP, there are many others who are out there, and some of the commercial consulting firms as well. There's lots of people out there providing advice. And what I hear from developing countries is, I need to be able to access reliable, high quality, independent advice as I think about how to do this, because this could be a game changer for me, and I want to avoid all of the pitfalls of the past, and I don't want to find that I've built something that won't work in the future. So So there is no doubt that carbon markets are going to be a big piece of the way in which we finance and engineer the transition. Yes, they have to be done with integrity, but I think it was Mark Twain that said that continual improvement is better than delayed perfection. And I think we're having a big discussion about perfection at the moment because people are worried. There's not a lot of trust in the bank from the private sector or from the financial sector, and that delayed. I understand the emotion behind delayed perfection, but in any kind of regulation of any kind of market, you put rules in place, you see whether they work, whether they're having any kind of perverse impact, and then you improve the regulation, and then you improve the regulation, and you improve the regulation. And I think we have to find a way to have the confidence to be able to do that. It would be much easier if countries stepped up to the plate and did what they said they were going to do in Article 2.1c of Paris, which is where they said all financial flows should support Paris. And so for countries that haven't put a price on carbon, that haven't built their trading systems or put taxes in place or all of these things, right? This is important work. And no country has done this well enough yet.
Yeah, well, you just said one of my favorite phrases, Rachel: progress, not perfection. Mantra for us to live by in politics and in building companies and making big change. So let's finish up with our final question here. And before that, a great big thank you to you to joining us today on the Smart Society Show. So next year will mark the 10th anniversary since the Paris Agreement, which you played a leading role at the time in helping to secure. Are you positive and hopeful at the pace of change that has occurred since Paris? And do you think this year we may finally see the final part of the Paris rulebook on Article 6, covering the development of cross-border mitigation in carbon markets? Do you think that'll be finally agreed this year?
Yeah, Article 6, I think will get agreed. In Baku, or in the run up, then to Belém in next year. But 10 years on from Paris, have we made the progress that we wanted to make? No, clearly not. We're not on track. Is that the fault of the Paris Agreement? No. There were some very important things that made the Paris Agreement happen. Some of those still exist, some of them don't. I mean, I always say that Paris was the ambition of the political leaders in Paris was only possible when their own domestic private sector and their own domestic voluntary sectors and other sectors were sort of saying to them, agree the ambition, we can do this. Agree the ambition, we can do this. So the role of business, I think, was absolutely critically important. The voice of business was critically important in Paris. But the world has changed. We're morphing into a world of economic nationalism now. From the United States to India to China, to rising pressures for economic nationalism, populism elsewhere in the world. And so that multilateralism is fraying at the edges, and a new form of multilateralism is potentially emerging, which makes some of this more difficult, but we have to sort of adapt to the political environment we find ourselves in. I think that every day that goes on where we don't make the investments and we don't free up the resources we have in the global economy to investing in the right thing, we're just making it more difficult. And then I think the science has arrived early, right? So we're now seeing the levels of extreme weather events, extreme heat. We're seeing pressures on insurance industries. I mean, we're now getting into the fundamental fabric of fiscal policy and how countries are going to keep themselves safe, protect the vulnerable, but at the same time reduce emissions and start to remove emissions from the atmosphere. So could we do Paris again now, 10 years later? No, but could we do something that would build on Paris? Yes, right? So we just always have to adapt to the political circumstances. Paris is not a failure. Our implementation has not been good enough.
Well, Rachel, thank you so much for joining us. It's been a fantastic interview, and we're really grateful for you joining the Smart Society Show today, and look forward to following your work as you develop your policy agenda, but also bringing up that next generation of climate sort of policy experts. Thank you so much again, and look forward to staying in touch.
Well, thanks, Chris, and great to be on the podcast, and good luck with it. Thank you.
Thank you. Welcome back to the Smart Society Show. We are now here for our Chasing Unicorns segment, and we are very pleased today to be joined by co-founder and CEO Allister Furey from Sylvera. Sylvera is a carbon data platform and just raised a massive Series B funding round here in the UK. So we're excited to talk to Allister today about building trust in carbon markets and just building a great company here in London. So thanks so much for joining us, Allister.
Thanks for having me.
Well, you know what, Allister, our listeners always like to hear a bit about the startup journey. I think, all the grit and the grime of building companies is quite interesting to people. So I thought perhaps we could start today with you sharing a little bit about your journey to starting Sylvera. And then if you're comfortable with it, maybe sharing a few of the twists and turns along the way to get to this great point where you are today.
Absolutely. Thank you. I'll try to do the abridged version. And so it's more of a narrative rather than the spaghetti of the reality. But the backdrop is super clear. It's climate change. So the world collectively has a big problem, right? So with respect to climate, we need to manage climate change to the absolute minimum. And we have this collective plan. I'd call it a plan B, which is net zero. Net zero itself is a compromise because it involves overshooting emissions and then clawing them back very, very expensively. But it's the best plan we've got. So my background coming in was really in technology, and my last company was in renewables, in wind energy. And unfortunately, we haven't decarbonized fast enough. So now we're in this world where the net part of net zero, the removals part, becomes critical. And the early vision for Sylvera was to say, let's take some of the lessons from the renewable sector and apply them to carbon removal, because there's a close analogy. You've got to deploy hundreds of billions a year into carbon removal, same as you have to do in renewables, or is already happening. Let's see if we can take some of the lessons and apply that to the growth of carbon removal. And we took a technology lens at basically saying, let's try and discover the opportunities to remove carbon with the lowest capex, the lowest opex, highest productivity, and lowest cost of capital. All the factors that drive cost in renewables. Discovered some amazing opportunities. Going out to my banker friends and contacts, basically saying, have this incredible project, and then just being laughed out of the room in a nice way, but then basically saying, yeah, carbon is fluffy. We can't lend. We can't lend against that. And nobody is going to lend against that. It's not considered sufficiently real, right? And so this was kind of a bit of a showstopper, because the business as it was envisaged just didn't have a future. But then very quickly we were like, well, this is a problem not just for the sector or for other startups, but for the planet, right? And the problem is, carbon instruments are a market without scales, right? So there's no trusted measure of the effectiveness of carbon instruments like carbon credits, and that makes them very difficult to invest in, to do long-term contracting. Like you might have a power purchase agreement for wind farm. Therefore, you can't get the investment. If you can't invest the trillions of dollars you need to do the carbon removals, we don't get to net zero. So it's like, well, this is like an existential problem, frankly. And the tightest bottleneck that we felt that we could solve was this data problem, to provide a reliable, independent test of the quality of the instruments to help make the contracting and the investment behind these projects actually happen, and also make sure that the climate integrity was there, because you could have $100 billion or $1 trillion spent on ineffective projects, and then you still don't get to net zero. So you might move the money, but it not do the job. But you need to move the money and have it lead to effective outcomes, and providing the data is the kind of the key. And we found most people didn't recognize that at all. Everyone was like, "Oh, the credits are fine, everything's fine." We met some enlightened senior folk at McKinsey who were like, "Yeah, actually, we see this as a structural problem too." And we started doing some work with them, and that kind of led to the development of the early ratings.
Cool, great. Thanks for sharing.
Alistair, thanks so much for joining. I wanted to ask, given that size of the challenge of eliminating emissions that you've spoken about, credits for carbon removal will obviously be a critical part in some form for most companies at some stage, but creating those trusted credits and markets requires much better data for accountability and transparency purposes. Now, we know there's a lot of skepticism out there because of that lack of data. Could you touch on how Sylvera is trying to solve this problem, both in the short and the long term?
Yeah, sure. I mean, I alluded to it before, but you don't have markets without scale. So you need to be able to measure what's being traded, and that doesn't happen accidentally or without thought or design. So, if you go back to like the very earliest written laws, like weights and measures, trade rules, feature in Hammurabi's laws. Also, like accounting, accounting predates writing. Like writing came from accounting. Now, with carbon, you have a really tricky pair of problems. So the first one is, you can't get to net zero with a single machine. You have to have many different carbon emissions reductions activities and many different removal activities. You'll never get to the aggregate numbers involved, which are vast, with a single lever to pull. So you've got very extreme diversity. And then there's another problem. Unlike when you go to a market or you to buy a commodity like oil or wheat or something like that, you never take physical delivery of the carbon. You take a receipt of a ticket that represents the fact that a carbon ton is injected under the ground, it's in a forest, it's out of the atmosphere in some way. So now you have this problem, hundreds of different activities you can't test. And there is, frankly, a strong incentive if you're benefiting from the number of credits from any given activity being high to overstate your impact. And that's whether you're a developer or a trader or a registry. Frankly, you're just incentivized to max out the number to the possible, and there's no legal kind of controls here, right? So our solution to that is to do really three things. Test the claims very, very reliably and in a very detailed way. So if somebody says they've delivered biochar or they've delivered direct air capture, to test those claims, and ideally use an external reference points where possible. So whether it's forestry, for example, agriculture, we can observe what the developer is claiming using satellite data. And then we're paid not on the basis of the volume of credits. So our business model is another thing. We need to be completely free of conflict. So we're paid by the buyers of the credits and the investors in projects. And for all of the kind of press narrative on this, when a corporate buys carbon credit, they don't want to be defrauded. They want to buy a real, genuine outcome in the world. So their incentives are aligned with us. They want to test what they're buying and make sure that it's genuine. And so to produce reliable data, to do that in an unconflicted way, and then start to bring in other data and tools that facilitate that investment journey. So that could be there's more than 20,000 projects on our platform. So just discovering what the relevant universe of opportunities are to understand price, when am I being ripped off? Could I have double the climate impact by purchasing different projects credits or credits from a different supplier, starting to kind of professionalize the procurement of carbon with this kind of quality assessment at the core. So that's how we fit into solving the problem.
Interesting. Well, I'm sure you hear, just like I do every single day, a lot of passionate market debate about offsets versus removals as the solution. We at Smart Society Ventures have a view that it's a puzzle where we have to put everything together. So I'm curious your view. Where do you see carbon markets in the overall puzzle, and what do you see as the future of that path to net zero?
I mean, like incentives explain a lot, right? So show me the outcome, show me the incentive. So when people are advocating very vociferously for one thing or another, probably they're profiting in some way from what that position, right? But the science is really super clear, and this is a nice thing about this market. Like, you can only get to a stable or like a manageable degree of warming by reducing emissions and by removing CO2 from the air. So that's the whole net zero equation. You get your reductions down as quickly as you possibly can as a priority. And then you have to also invest in removals. You can't get to net zero from either one side of the equation or the other. So they do have different attributes. It's more challenging to do the accounting for carbon reductions that often underpin offset instruments. Because they involve sometimes a counterfactual, like we're stopping this thing happen, and that counterfactual gives more opportunity to fudge the numbers. So, but does it mean that you can't observe, if you can stop deforestation, that's observable, right? You can observe the deforestation. So if you can observe the stopping of deforestation, that's quantifiable. It just requires a lot of work and effort to do that. But it has given rise, the amounts of degrees of freedom has given rise to significant misstatement in the past. On the removal side, theoretically, it should be easier to quantify, but actually it's painfully easy to fudge numbers for carbon removal as well, which is something that advocates tend to gloss over. And actually, the transparency point, the data availability, is much better for legacy credits and registries than it is for carbon removal vendors, who tend to be very secretive, which is not, So then you have like secrecy plus economic incentive. That's going to give rise to misstatement as well. So it's inevitable, right? It's just that the incentives playing out. So you still have quality assurance issues on both sides, and you need both sides. So we're agnostic. We cover the full spread: nature, technology, removals, avoidance. You need everything. There's no way to get to net zero. It's all levers all at once.
Allister, I saw an announcement recently that Google have said they're not going to be purchasing carbon offsets at present. And I wonder what you felt that meant now for potential demand for offsets for the foreseeable future. Do you think others will follow suit? Is this a movement that we should be watching?
You do have different types of carbon markets. So really there are three. So you have voluntary markets, you have compliance markets, and then you have, now under the Paris Agreement, interstate trading of carbon under Article 6. So with voluntary markets, which is the Google announcement is relevant for, it's voluntary, right? Voluntary markets are voluntary, right? So it's a discretionary thing. And then it's a balance of costs and benefits, right? But what benefit does Google get for doing the right thing and financing decarbonisation outside of its supply chains and value chains? Quite limited now, especially when there's a lot of press scrutiny. Having said that, you're seeing players coming in and out of the market. So Google putting things on ice doesn't mean game over for the market, just as much as Apple leaning in and doubling down in the market doesn't mean suddenly like everything, which they did do last year. And Lufthansa came out just in the last few days saying that they're weighing in. It's kind of more, it's more like noise than signal, really. So ultimately, what we're expecting and seeing is the convergence of those three markets. So the ability to use voluntary credits in a regulated compliance regime, to use Article 6 ITMO credits in corporate offsetting regimes or compliance regimes, And that underpinned by regulatory action. And that's really, so we tend to work with the very largest corporates, big funds, very, very like tier one corporates, biggest companies in the world. Their perspective is that medium term one. So they're trying to figure out, look, we know we're going to have to get to net zero. We know that carbon instruments are going to be a big part of that. How do we map out our carbon liability and think about it as managing an emissions liability? Build lines of supply, anticipate which types of credit are going to be eligible for which regulatory hurdles that are going to come in different jurisdictions they operate in, and build out an entire strategy. And then on the investment side, you have the inverse happening where the folk investing in these projects are trying to map out the market and how that's going to emerge, and where the hot spots are, where the price is going to be high, where it's undersupplied, given those regulatory timelines. And then you do have the third set of actors who are like the institutional investors that effectively own these public companies, also very interested in figuring out when these theoretical carbon externalities are going to be internalized. And that really then starts to drive action, because you start to reprice these giant companies on the basis of their carbon liabilities and how they're managing them. So we interact at very high levels, kind of board levels within companies. They're trying to, it's not just like, hey, which credit should I buy, this week and put on my website, it's more like, wow, we've got margin dilution for the entire business to manage. And then there's a question, do we spend more now to have a lower margin dilution, which is literally going to change the entire value of this stock and all of those execs' pay packets? Or do we wait and potentially take more risk because you're going to pay a higher price the more you wait? So really interesting conversations, and the sort of, the noise of the market is not really what we experience when we're having those more strategic conversations.
Fascinating. So continuing on the regulatory point, Allister, maybe double clicking a little bit more, it does seem that a lot of the future of carbon markets, whatever that looks like exactly, does hinge in some way on net zero regulatory requirements kicking in, and effectively sort of forcing companies to buy credits when they can't cut emissions deeply enough without them. Which regulators do you see leading the charge and doing things well? And which regulators or countries do you see who need to do more?
Yeah. It's worth almost going to the first part of your statement, because it's so fundamental. Carbon credits have been described as like indulgences. If you buy this credit, you therefore don't have to decarbonize. And in fact, you don't really see that in reality. Most of our users, they're decarbonizing and they're trying to do the right thing by investing in decarbonization externally as well. But if you frame a credit as a penalty rather than an indulgence, and you make it to be as an obligation rather than an option, suddenly that's an internalizing the cost of carbon. So you're putting a carbon price that's real and not theoretical. And where some decarbonization goal hasn't been met, you're taking the money, the penalty, and you're putting it to use to actually deliver carbon emissions reductions or removal activity elsewhere in the world. So that actually is a coherent system that actually hasn't been deployed really anywhere other than, you might say, emissions trading schemes. Now, emissions trading schemes give you the first part of that equation. They disincentivize investment, but they don't directly take that money, all those fees you pay for your emissions allowance, and link that to carbon removal, which is a huge. And the EU is likely to, it's charting a path to allow that to happen. But actually, there's no real way to get to net zero without forcing companies to pay that carbon price. Otherwise, their duties as the directors' duties or the elected officers' duties are primarily fiduciary, right? They have to look after the financial interests of their stakeholders above everything. So you actually need to force their hand. Otherwise, at scale, which is we're talking about hundreds of billions of trillions of dollars, they won't spend that. So it's literally impossible for them to spend it. we think that these mechanisms are really necessary. And you do see some governments who are kind of charting a path there. So Singapore is a really clear example where you can, they're allowing a path where you can buy a credit which has some additional guarantees of quality, not just any old credit, and use them against a tax obligation. So, if you maximize the quality, the reliability of the impact of that credit, fantastic. And then you're basically creating a financial incentive for them to do that. And the tax obligation is linked to their emissions. So you can lower the obligation by emitting less. But when you do emit, you're going to take that money and it's going to be deployed directly unspent. That's a nice mechanism. You also see Japan doing a lot of different mechanisms, again, kind of similar, but not the same. Switzerland is ahead of the curve for sure. So in Switzerland, at the fuel pump, they've effectively forced the internalization of the carbon cost of fuel by mandating that the operators of those fuel stations, those fuel distribution businesses, buy compensation. So then you're exchanging incentives for them, and then you're also linking that with a real world outcome. It's a good mechanism. They're just too piecemeal at the moment. So what we do is we chart the kind of future regulatory paths. It's all very uncertain. And that's really what the investors want to see. And this is what the corporates want to see. This is kind of part of the picture. Like, what do I have to do? What should I do? Should I jump first or should I wait until I'm forced? There's all these like real world decisions to make. But we just need to see more. We just need to see the regulators get more aggressive. And then you do see these kind of tipping points emerge where the benefits accrue to those early actors. So, the UK in particular has all of the things it needs to build an amazing ecosystem. You've got finance, you've got lots of sustainability professionals here. The UK should be the carbon trading hub of the world, and it can set standards. It can make sure the qualities are there. You do need some kind of the new Labour administration. They should be like fully grasping this opportunity. We hope they do.
Allister, last year Sylvera raised $57 million in its Series B funding, led by our friend Allister Capital. Congratulations on that. I wanted to ask you, what's now next for Sylvera? Obviously, we've spoken about what's potentially might happen in the carbon markets in the UK. Would love to get an update on where you're at and where you're going to.
So we started testing quality of credits that can be bought today on the market. That's the kind of hair on fire problem, the thing that the buyers were really struggling with. We've expanded there in two dimensions, testing the quality of projects at the investment phase. And we do that for either corporate off-takers or investors in those projects. So it could be a fund, it could be a bank lending to the project. So you get to resolve some of these quality issues proactively rather than reactively, which is much better. You want to kind of raise the bar across the board. So that's satisfying from a mission perspective as well as an economic one, and then assuring those projects over time, making sure that they stay within their bounds. They're going to pay back the debt and they're going to deliver on quality and quantity and cash as a result. So that early stage data set has been a big growth lever for us. And then the other one is that the processes are underserved. So every business is going to have to buy carbon. It's going to have to comply with certain needs. And there isn't really a set of professionals that know how to do that workflow well. We see what good looks like. And so we're building tools to deliver that end-to-end workflow, from defining the strategy through to execution, through to monitoring, reporting, portfolio management. So our business we've evolved into a platform that serves those end-to-end workflows. And it's powered then by this proprietary data on quality that gets injected into the relevant points in the workflow. So that's been the kind of the journey for us.
Well, congratulations on the journey so far, Allister. It's not for the faint of heart to build a company from nothing to this scale-up phase here in the UK. So kudos to you. We're going to finish up with one last question here. since this is our Chasing Unicorns section, we like to end with one simple question. So why is Sylvera going to be the next UK and European climate tech unicorn?
It doesn't take a lot of complex maths. It's just back of envelope. You think about internalizing the cost of carbon, putting a price on carbon. It's a multi-trillion-dollar shift. It's a vast economic shift. Basically, the price of everything changes in a world with a carbon price, and a new industry is created, and this new commodity and this new asset class. So that's kind of. That's there. And like key to that is trust. So we're kind of coming back to the top, you need the trusted actor. We've won the trust of many of the top financial institutions who use our data, top corporates, and we also serve government clients. The Singaporean government, we've publicly announced that we work with. So yeah, like as we go through this transition, we're really well placed to enable the deployment of all this capital. And of course, in doing so, I mean, we're a mission oriented business, but yeah, we do get paid, and our clients are happy to pay. We create lots of value for them, and they actually need a private sector actor because they need to be able to rely on us being available in the next 10, 20, 30, 40, 50 years and not subject to the whims of, donor funding. We have to be suable as well, right? So they need to be able to take us to court if we get things wrong. So basically, you have this secular trend. You need to decarbonize. You need to spend this money. You need an actor that facilitates it, provides the tooling and data. And we're one of the very few trusted actors to do that. And ultimately, being long climate and like a climate transition is sort of being long, having a future, literally like having a sustained complex civilization. It's like that, if you don't solve these problems, you risk future, right? So like there are enough people that realize that the transition is hopefully inevitable. It's a question of how quick it happens. But definitely there's a significant business to build as we deliver on the mission.
Well, I absolutely love that quote. I will be repeating it and giving you full credit that being long climate is being long, having a future. I'll make sure all of my friends in America on both sides of the table hear that one as well. And with that, we could finish up and say a great, great big thank you to you, Allister. Congratulations.
Thank you very much.
And thank you.
Pleasure. Thank you so much for having me.
And to our listeners,